So, guys, how's it all going? I don't know if some of you were in my previous webinar I did last month actually as well. Been busy doing my thing and had a few emails coming in from all of you as well. You can actually type your comments and questions in the chat box. So I'd love to be hearing from you as we speak as well. If you're unsure of using that, just the team, if you can just let them know how to do that, that would be really good. Hey, greetings from California. Wow, good stuff. It is an early one for you. Well, actually say early one for you. I'm in Philadelphia, so it's 7 a.m., right, Michael? So it's 10 a.m. here. It's just gone 10 a.m. here on the East Coast and 7 a.m. on the West Coast, 3 p.m. In London. I hope you're all doing well and happy. So good to have you here. So I started a session. I just joined FX Street again after a hiatus for a couple of years. And I've been asked by the team and Online Trading Academy, who I represent, to come in here and kind of give you some previews of what we like to do at Online Trading Academy as well. Excellent. Quebec. I love hearing where you guys are all from as well. Hi, Michael. So as everybody's drifting in, I don't want to waste any time. We've only got 45 minutes. I don't know if any of you were in the last session that we did, where I gave you a brief introduction into Online Trading Academy's core strategy, something that I had a hand in helping to co-develop over the years. Worked very closely with a gentleman who I'm sure many of you are familiar with, Sam Seiden. And I revolutionized my world, and I've had lots of people say to me, how can I make trading simpler? How can I make entries and exits simpler? How can I really kind of get away from all of the mess? And the idea of what we're trying to achieve over these next few months is how to just use price action to find trading opportunities, cutting out all of the unnecessary junk. There's a lot of different things out there, moving averages, all of that kind of stuff, and Bollinger Bands, and it's crazy. And I'm not going to go too slide heavy today. What I want to do today is I really want to just recap a couple of slides for about literally 15 minutes, and I want to jump over to the slides and show you a little snapshot of the things that I'm looking for. That'd be good, guys. So I just want to kind of review some of the concepts of what we're looking for here, and then to also understand, obviously, just looking at the charts in a little bit more. And I will be doing at the end of the session, I'll show you how to stay in touch with the academy, and later this month, well, actually it's going to be next month because we're almost at the end of this month, but in March I will be doing a premium webinar with FX Street, which I'll give you a little bit of the details on before we leave the session as well, and then the team will get out an email to you so you know when that's going to be. So one of the concepts that we actually talked about last month when we were in here was, okay, a lot of people struggle to make money in Forex. We have a lot of very gifted educators here on FX Street, so we're also very fortunate to have many individuals who do know what they're talking about, but they're few and far between. And I'm very humble about this whole thing. The market, you're only going to be right until proven wrong, right? So I like to just look and say, who is right all the time? Who is a group who tends to consistently make money over and over again? And the institutions and banks do. We talked about this last time. Most people struggle to make money in the Forex market because they're thinking and acting like a retail trader, using a lot of retail tools and don't even know it. What we want to be doing is really kind of getting in to start understanding a little bit about, okay, what about these guys here? What about the banks? What about the institutions? What do these guys here do? How do they make money? Well, they treat this like a business, guys, and we want to change our mindsets to think like the banks and to think like the institutions. And as I've said, people almost laugh at me when I show them this slide, guys. Okay, you want to make money in anything in life, you buy low, you sell high. That's it. Now, this is all relatively speaking, obviously, because we have trends. And I want you to write this down, but this is a really important concept that I want you all to understand here. And what I'm going to go ahead and do is I'm going to go and open up a tool on here that I think is gonna help us, and I want to just go in here and I want to open up the paint pad on this and just show you on here just the idea of it. So let's just go over to a little paint pad, and then we're gonna literally jump on to this itself. So let's just go over here, paint. So I want to just do, there you go, that good old-fashioned paint. That's all good. That's what we want, right? So when we're looking at any kind of, oh, that's perfect. When we're looking at any kind of chart, there's really only two types of trading that we can do. And I make this concept here. We want to buy low, sell high. People say to me, well, there's only ever going to be one extreme low, one extreme high. How can I make the most of that? All these things. I'm like, listen, what you got to understand is this is the concept here. There's two types of trading you can do. One, which is trend trading, which involves an existing trend and going with that existing trend, be it an uptrend or a downtrend. Now, where could we join? We could join at key points in this trend. And there's many people. Sometimes people will buy the breakout here as the price goes higher. Some people will look for the pullback as it goes higher and buy it here. These are pretty easy these seem like the obvious entries, because here it's like, well, if it's gonna break these highs here, it's probably a good point to jump on here. Or I want to wait for it to pull back a little bit to get it relatively low for I expect it's going to go higher. These are joining a current trend, right? But there's also another concept that I want to share with you, which is how about getting in the trend at the start? So if I could get into a trend at the very start of the trend, what's my risk to reward ratio going to be like? It's going to be huge. And risk to reward ratio is the thing that's going to keep you alive in this game. You know, in this, and I say in this game, because guys, that's what this really is at the end of the day. This is a game. And, you know, what we're trying to do here is understand very, very clearly on this that, you know what, we just want to have enough longevity, you know, in this business, in this game to make money and to be consistent. And guys, to do that, what we have to be doing here is making sure our risk to reward is strong, making sure our risk to reward is decent. I will not look for any trade that doesn't offer me at least a 3-to-1 risk to reward. So if I was going to take an entry with any kind of stop loss, that one would be my maximum risk. I'll be looking for at least 3 times that as a gain. So yeah, when you're trend trading, that's great. You can get that, but you're making the assumption the trend is going to continue. But as we know, trends also do this. They go up, they spend a bit of time down here, and then they have a reversal. And here you are buying the trend here, only getting minimum upside before the trend actually does a complete reversal on here. So the second type of entry would be, wouldn't it be beneficial if we could get into the trend somewhere around here? You know, the best time to join a trend is at the very start of the trend. So you can either join an existing trend or you can try and get in at the start of a brand new trend. Which of these two is going to have the biggest risk to reward ratio? Well, number 2, getting in at the start of a brand new trend. And what I want you to think about is where this concept comes from. Is if we take this just back a section here, who makes money? I went back on a slide here. Institutions make money, and institutions create trends, guys. Institutions create trends with their demand and their supply. And by using this demand and supply created by this massive order size that they have, they're going to create these moves that we can actually use in our own trading and our own Forex analysis to actually participate in these bigger moves as well. And that's what we're here to talk about today. How do we trade? How do we get a little piece of this like the institutions? How can we get into the market like an institution and enjoy some bigger upside on here? See, this is an observation that I would really like to make, because also someone says, well, what about news as well? You know, doesn't news play a really, really big part in this? Okay. So, well, yeah, news does play a big part in this. I'm sure a lot of you guys have, you know, read the news and so on as well. But the problem is with the news is the news only comes out after the effect. You know, we get the news that comes out and then the price action happens, but it means we're going to be typically too late to the business. And I always ask this, you know, when we're looking at basic charting on here, all these different pieces of news that come out are basically traps if used wrong, and maybe opportunities if used right. But the issue we've got is with all this information on here, how can we do one of these two things? Join the existing trend or get in at the start of the trend? Because here's the problem you have. When you read the news, the market will move first, and then the news will come out to justify why the market went higher or why the market went lower. If you can find me a newspaper or a website that's going to tell you what the market's going to do before the news happens, don't share it with anyone, right? Keep that one to yourself. Because I don't care what the information is. All these different things, I call this the minefield, right? Earnings, news, income statements, balance sheets, in Forex, FOMC day, non-farm payrolls. All these things do is create thoughts and perceptions, actions to buy and sell, which in turn translate to market movement. Well, the issue we've got is this. One analyst may be telling you one thing, another analyst may be telling you another thing. There's never really any consistency here that we can use. So what I chose to do is this over the years, and I'm working with some of the best individuals, like, all right, Goldman Sachs aren't going to send me a memo before they invest heavily in the euro. You know, JP Morgan aren't going to send me an email saying, hey, tomorrow we're going to start looking to start shifting, 5 billion GBP or, 5 billion Swiss francs. They're not going to tell me that before. Why? Because if they start telling us what they're going to do before they do it, anyone reading that story is going to go out and then they're going to start saying, well, if Goldman Sachs are going to start selling the pound this week, I better sell the pound. If JP Morgan's going to start offloading the Swiss franc this week, I need to get a jump on that and I need to do it. What benefit is there for any institution to tell the general public what they're going to do before they do it? And this is a question I get. People say to me, man, you don't like fundamentals. I'm not saying I don't like fundamentals. But what benefit is there for any major bank or institution or hedge fund to tell the public what they're going to do before they do it? What that's going to do is just bring everybody else into the market, and it's going to affect their price. They're not going to get the price that they want to get. So what they're more likely to do is start buying up ahead of time, creating massive pools of demand and supply. And then when these moves happens, the press will go, oh, why did that move happen? Oh, because Goldman Sachs have been buying it. Apparently a report comes that they've been heavily invested in gold because they're worried about their risk appetite right now with the stock market. Do you understand what I mean here, guys? You're not going to get that memo. So, when we look at all these different thoughts and perceptions that are being created by this news, when we buy and sell, we're doing it all off of subjective analysis. Well, we don't have to, because these charts that you see here are going to show us the footprints of institutions. These charts are going to show us, hey, here's where the big guys are likely to buy and here's where the big guys are likely to sell. So I don't care why. I don't care why a major market player is buying. I don't care why a major market player is selling. You know what I care about is where. I just want an idea of where the big boys are buying. I want an idea of where the big boys are selling. That's what I want to do. And if I can get an idea, what can I then do? If I can get an idea of where they're buying and where they're selling, what I can then do is I can use that information myself to place trading ideas. Is this making sense, everybody? Okay? Because I've had some emails, I had some really lovely feedback from my last webinar I did, and everyone was like, I had some great people saying, oh, I really enjoyed what your concepts were, but how can you just ignore fundamentals? There are these guys who work on these major trading floors, respected speakers who will talk about fundamentals and so on, and you're saying it's no good. Hey, listen, fundamentals, I've worked in hedge funds. I used fundamental analysis to make decisions on what I was going to invest in. The difference is, though, I wasn't trying to make a few pips on a Forex trade. We were trying to make big moves. And when we decided, because of our analysis, what we wanted to buy and why we wanted to buy it, we set up our orders and we start with buying. And we buy in big chunks. And we weren't telling the public about it because we wanted to buy and get the best price for ourselves. Do you understand that, guys? That's a really, really important concept that not a lot of people get their head around. And it's one that I suggest you do start getting your head around, because what we're trying to do here, guys, is create an edge. What we're trying to do is create an edge for ourselves. So this is how we are going to create an edge. Let me show you this concept here, and then we're going to take a look at some price charts and see. Basically, and this is probably one of my favorite slides that I use whenever I do like an introduction to this lesson of supply and demand, and here it is right now. So I showed you this last time. And basically, we've got something you need to understand, everyone, is the market has the willing buyers and willing sellers. And when we have willing buyers and willing sellers, these market participants have their reasons for buying and selling. If I've got 100 or 400, I've got 400 buyers here at a particular price of an asset, and I've only got 100 sellers of that asset, those buyers need sellers and those sellers need buyers. So if these sellers satisfy these buyers, that's great. This is a representation of supply. This here is a representation of demand, right? So if these sellers have wiped out these buyers, what we've still got here, though, are 300 buyers. We've got a picture of demand, but zero supply. Price is going to go up to this point. If supply and demand are equal, if we had equal buyers and equal sellers at a price point, 400 buyers and 400 sellers at a price point, the price isn't going to move. But if we have an imbalance between these two things, price is going to move. And the origin of any change in price is where either the buyers and sellers become zero at a specific point. That is what is key here, is when the buys has become zero at a specific point, because these are our simple rules we have to understand. The lowest risk, highest reward, and highest probability trade points are always going to be near turns in price. What did I say? Think back to my paint tool here. Here's your turn in price. The biggest, lowest risk, highest reward, here's your 1, here's your 5, are going to be near the turns in price. We want to get in near those turns in price, these key turns in price. This means we need to be able to time these turning points in advance with a high degree of accuracy, and it also therefore means we need to understand where supply and demand is out of balance. So I'm going to suggest to you a style of approaching the market where we're going to look for these footprints of where these institutions are buying and selling. And by looking at the footprints of where these institutions are buying, selling, what we can then do is start to use this for our own trading and our own market speculation. So let's just go over to this and just show you. Imagine, what I want you to do is quickly imagine a set of orders on a chart. You've got a market basically that's traded as low as $10 in the past and traded as high as $80 in the past. You know where most of the trading activity is going to take place? Somewhere here in the middle. Why is that? Because it's always easy to get in the middle. Price spends most of its time in the middle. At the average, guys, that's where price spends most of its time, in the middle at its average. Now, with this in mind, okay, this is just like any other vehicle on here. If I've got a lot of money and I'm interested in investing in a product, I want to buy as much of it as I can when it's cheap, and I want to sell as much of it as I can when it's expensive, right? So now if you think about this concept here that we are looking at for just a second, and let's just go take these, let's just erase all this ink on the side for just a second and turn this on its side. Okay, what you've got is this same concept of massive order flow at the extreme lows and the extreme highs can be put into practice by then looking at a price chart. What I want you to do is to look at this area right here. Okay, notice the rally in price and look at this sideways action that we have, and then what did the price then do? It took off like a rocket from this area. Now there's a couple of things that we can look at. Let's call this point A. There's a couple of things that we can say about point A right now. Point A is telling me two things. Number one, there's a ton of demand here. How do I know that there's a ton of demand in this area? Well, what did the price do? The price took off and rallied like a rocket from this area. Remember the rule, if demand is greater than supply, prices will rise. If supply is greater than demand, prices will fall. Okay? So obviously demand was greater than supply. Okay? Great question, Michael. Okay? I'll be back on that in just a second after I've gone through this point. Okay? So, at point A, demand is greater than supply. What it tells me is not only was the demand high, who's got enough money, do you think, to create massive areas or massive price demand? A guy or girl sitting at home trading on their laptop in their basement? Or a major institution or bank? Who's got the buying power to do that? Obviously, it's the banks. They're the ones who can create that kind of demand. So clearly, it's institutions are always controlling the price. The other thing I know for a fact is in this area at point A, those buyers didn't get all their orders filled. Those buyers didn't get all that, because if they would have got all their orders filled, those buyers would have needed an equal amount of sellers. Understand, price would not have come up from this area if there weren't less sellers and more buyers. So then at point B here, when the price returns to our area, this gives me an opportunity to buy here, because if these guys didn't get all their orders filled at point A, then if the price returns back to this area again at point B, this is a low risk buying opportunity for me. Now, what's going to do is it's going to confuse a lot of novices out there, because the novices can be saying, well, Sam, that's in a downtrend at that particular point. Well, is it in a downtrend here, or is this a pullback in a greater upward trend? And that's big picture analysis. That's a discussion for another day. But I know for a fact that if I buy at point B and I maybe put a stop loss below this zone at point C, and I have a target up here at point D, I'm going to get a low risk opportunity to buy near the lows. Okay. So if we take a look at this for just a second on here, okay, this is the principle that we've got. Now, a question I got here, great question from First Michael S. Sam, what if all the orders in the zone, demand and supply, were months or even years ago? Aren't they cancelled already? That's a great question. So something you should understand about this is when I learned about this concept, it was from working in the industry and thinking about it. There's a system in the market that it's called first in, first out. And it's like when you go to a store, think about Christmas time when your kid wants, the toy. And the toy's in limited supply at Christmas time, right? So you go into the toy store or you go on Amazon like you do today and you try and buy it and it's out of stock because everybody wants it. So you have to go on the waiting list and you put your order and say, hey, next time that toy comes in, I want to buy it. It's first come, first serve. Your neighbor, they need the same toy for their kid, but they go in a day after you. They put in an order. Well, they'll say, well, there's already, 10 people already queuing up. I can put an order in for you, but it's first come, first served, right? It's the same thing in the market. When you set an order in to buy or sell, it goes into a queue system. And it's called FIFO, F-I-F-O. It's been the way the market's been traded in all asset classes ever since it started. First in, first out. So if you put an order in to buy something, and then you decide to cancel that order, and put that order back in, you're going to go to the bottom of the pile. And what you've got to remember is this, as an institution, as a bank, as a hedge fund, you're trying to get as much as you possibly can at that price. So the issue you then have is if you start cancelling your orders, guess what? They're going to go back into the pile at an awful price. And we aren't talking about getting, a few hundred lots here, a few 100,000. We are talking billions. Do you understand? So especially in the world of stocks, and to answer Michael Rodriguez, his question, do you interpret supply and demand stock market like Forex or those other instruments are completely different? I interpret it exactly the same. And when there's limited inventory out there that you can buy and sell, guys, what you've got to understand on here, when you've got limited buy and sell inventory on this, is that you literally have to take these trades as and when they come, and institutions are going to use these zones because once they put those orders in, if they cancel them, they go to the bottom of the pile. They want to give themselves the best chance of success. Does that make sense, guys? And in fact, just to ask you, that's a great one. Michael, you just said to me, do I interpret it the same play in this Forex market? I day trade every day as well as being a Forex trader. I day trade. And I'm going to show you an example of this in just a second. Because I had a trade like this hit this morning on the NASDAQ futures, and I'll show you in just a second. So one of the things I want to take you from this, and then we're going to go over to the charts, is this. What confuses a lot of people is this, is here we have our institutional level of supply. Again, look at the strong drop in price that occurred from this. Let's again call this point A. At point A, we had a massive drop in price. Why? Because whoever was selling there, one, had a lot more money than us because they could literally, their supply created by their sell orders was so big that it dwarfed the demand. And who's got enough money to do that? And also, they didn't get all of their orders filled. They didn't get all their orders filled. So the next time the price came back here at point B, what are we doing in this area? We are looking to sell for the push to the price down. Here at point C, what were the institutions doing here? Buying in bulk with not enough supply, not enough sellers to satisfy that, causing a rally in price. So therefore, if the price comes back to point D here, what are we going to do? We're going to buy, right? And where it confuses people, and this is why I don't care about the news, is, guys, think about when a market's high. When a stock, a currency is making new highs, the news is always what? Good or bad? You're not going to see a currency pair making new highs on bad news. The news is always like, well, here's the reason why the euro's doing well right now. Here's the reason why the Japanese yen is so strong right now. The news is always going to be good, but the problem is the price has to be high when the news is good. And when the price is high, when the news is good, most people then start buying. That's the time, if there's supply, for us to do what? To sell. Likewise, when we have very bad news in the market and everybody's panicking, this is when you're going to get the best buying opportunities because the market's down. I never see a market making new lows on good news. I see a market making new lows on bad news. But that's the best time to buy if an area of demand is being created. And then when we put this all together, we can take different asset classes, Forex, currency futures, and so on, and plot these areas of supply and demand and play ping pong between these areas. Because if we can now play ping pong between these areas, these areas of supply and demand, and they have got at least a 3-to-1 risk to reward. Does trend really matter anymore? No, because we're going to be playing price between the trend. I want to get in on every piece of the trend. So what I'm going to do is go over to the charts, okay? Michael Rodriguez, you asked me, is it completely different with stocks? So let's take a look today. So this is actually a trade that I had in my webinar. Now, this thing's already gone higher. I just took a nice standard 3-to-1 on this trade, but I want you to take a look. And then I'm going to move over to currency because obviously that's what we're here to talk about. But you asked me, is it any different? I want you to look at this area right here at 709275. Okay. Now, if we take a look on here, I'm going to just go to say format account orders and positions on here. And it might even show me on here, if I do this, the filled orders. Perfect. So let me just zoom in so you can see this here. This here, L2. So I did a 3-to-1. In fact, you're not going to be able to see that. You know what's better? Let me do it like this for you. Perfect. So let's do it like this. Take a look at the area here. So I want you to look at this area. If I hover my mouse over here for just a second, I don't know if you can see what that says there, but in my bottom right of my screen, it says there, buy 2 at 7092. Right here, 709275. You see that? Okay. So this area here was where I bought today. In fact, I can go down to a smaller time frame and you'll see this even better. So here's the area, right? So let me just lock this out. I only took a 3-to-1 trade while I was prepping for the webinar. But if you take a look at that candle there, can you all see that it says buy 2 at 7092 at the bottom? Do you see that, guys? Buy 2 at 7092. That was where I bought today. Why did I buy there? Because this offered me an area of demand to the left-hand side, which I'm going to show you. Then we go on here, 7092, sell at 7110. Just a simple 3-to-1 trade that we took on there. That trade lasted about 20 minutes from 34, just under 20 minutes. And you'll see on here, if I just do my P&L, firstly, you'll see why I bought there. Look at the area. See how we had a bit of a base and we had such a strong demand area from this. Yeah, there's the wick that touched my area of demand. That area was a massive demand zone that caused a gap up in price. As price came back to this area, this was a buy opportunity for me to get a nice simple 3-to-1 in about 20 minutes for some income. I can go over here, put my quote bar in. You'll see your P&L on there, guys. There you go. I don't know if you can see that at the top right of the screen, but it's a quick $750 in about 20 minutes. Okay, that we did this morning by buying off of our level of demand. Okay, you can just see your closed P&L right off there as well. And yeah, it is a live account, by the way. I want you to see all my account number, but just so you can see, I only show things that have happened on real accounts. So, for a quick, easy 3-to-1 in and out and done, and I can take some other trades of some other good areas come later on. But the same principle as you were asking me applies to Forex as it also does to a market like this, which is the futures market. Okay? So I could probably have the zoom action on this as well. And next time we do our session, I'll make sure the zoom's on here. Let's go over to take a look at some Forex market. It's going to get some questions. We're going to look at some Forex, okay? And I'm going to share with you a little tool that I think is going to help you to try before you go away today. So Michael says, Sam, how about pivots? What's the difference between pivot high and low and demand high and low? So I'll show you. Yeah, I'll show you. So let me give you an idea on here. Oh, and by the way, real quick, and I want to answer that question, and I want to share this with you. Great example, okay, is did you guys remember this that happened? This was on January of this year, January 3rd of this year. We had that crazy spike on the Aussie dollar. Remember that, guys? That crazy spike that happened on the Aussie dollar. If you track that thing back, because people turn around to me and say, oh, and this will answer your question as well, Michael. People will say to me, news does matter. Look at that spike. Well, here's the thing. That spike happened from, no one really knows, some kind of flash crash we had, whatever it would be, I don't know. But notice where it came back. And this is a trouble that a lot of people get into. So here we've got our area. And this is the spike that happened. And people go, oh man, look how it blew through this demand area to the left-hand side. And I'm like, what demand area? Now, this will answer your question, Michael. I'm like, what, you talking about this? And I'm like, yeah, Kim Jong talk, right? The flash crash, okay? Who cares? I mean, problem is, the news comes out, they'll tell you why that drop happened, right? The news will tell you why that drop happened, but it doesn't help you unless you're in it the right way. Right? It doesn't matter what caused it. What cares is what do you do afterwards, right? What do you do afterwards? Okay? So, let's take a look. Now, this here, people say, well, doesn't that look like a demand area there? Here, we have got a drop down, but to me, this is just kind of a pivot low. Like this here is a pivot low to the left-hand side. These are pivot lows. We don't have any real order flow going on here. Notice by any kind of, condensed, bouncing candles. Notice the difference here. See here? See how the price came down and we got a very strong move away in the price. You see that big elevated candle? And we had a little kind of pausing candle before that happened, and then the price reacted and respected that area really nicely when it returned to it here. You see that, guys? How price reacted to that area beautifully, okay? Well, see, the origin, this wasn't here, the demand zone to the left-hand side. In fact, if we go and take a look, the true demand zone, if we go all the way back, was right down here. And you'll notice here, look at this. This here is our demand zone. Now, this is also our old demand zone still viable. Well, this is a level created, a zone created back in 2009. This is a reference point for the market. What is the difference between this area and that previous area? Notice we rallied. There's a little bit of a base in that candle where that order flow condensation happened, and then that really powerful move away. And that price hit here before reacted, hit here again, and look what happened. Once again, hit and bounced off that same area. The actual demand area is going way back. And what you've got to understand is this. These demand zones, the more they get tested, the more likely they are eventually going to break. If this price came back down to this same 6941 to 6769 area, I would not be a buyer again on this area, because the price has been here so many times now that it's likely that it's starting to wear out a little bit, and the whole mindset's changing. But a lot of time people get it wrong because they're not looking back for that really strong move away, and they confuse what is a typical normal support or resistance area, or they're looking for it in the wrong location. Okay, guys? So let's go look at some more, because that kind of answers that great question that we've got. And I think if I remember rightly, we were looking, this is it. Actually, in my last webinar I did with you, this is the area that we were looking at on the pound dollar in the last webinar I was at with you. This key area here. Now notice again, very powerful move away. That tells me that institutions were trying to buy a lot down in this area. And look how sharp away that move was. So when the pound has come back to that same area again, notice how we've been reacting from that same area. Okay. So again, we want to see those strong, powerful moves away. And when it comes to the best time frame, that's a good question, okay? And that is a higher time frame. The demand area, that was a weekly chart. You're not going to get much bigger than that. That is a weekly chart that we see on that Aussie dollar there, which is exactly where that area is. And again, this is like learning a language. When you know what you're looking for with supply and demand, it becomes more clear to you. You got to remember, I've been doing these supply and demand zones for about 16 years. Okay. Or you could go to a 3-month chart if you want to. Listen, if you change your chart frames around enough, you'll always find what you're looking for. For me, the weekly chart gives me more than enough information. But if you can see it on a monthly chart, all the better as well. A monthly chart, just as good as well. Yeah, let's take a look at it if you like, and then I want to go back over to those other charts, but we can look at that on a monthly, and you'll actually see that this is one big monthly area, right? But you can even hone down and see the weekly area within that too. So you're absolutely right. You're absolutely right, Carlos. So if we go back over to our weekly charts again and take a look at the cable, this here was the area we were looking at on our first webinar earlier in January, which was our key area of demand that we were expecting the price to rally from. I also believe that we'd been marking off some other key demand on a smaller time frame as well, a little bit higher. So again, these areas you can start to see, hey, anyone joining that downward trend here, if they were unaware of this to the left-hand side, they'd have been joining that trend far too late, okay? So when prices trend to the upside, are you only spotting previous demand zone to enter a trend? Yeah, I mean, I can do exactly. And I tell you what else I'm going to do, I also need to understand where I think the price has got the best chance of turning to. And this is something that I'm going to discuss in a lot more detail on my previous webinar, like joining a trend, because in the next webinar I'm going to do, the premium webinar, we'll have a lot more time. That was going to be a subject that we'll put together, because for this stage what I'm going to do is I'm going to set you kind of a little task, and then we can bring the trend trading into it. But yeah, if trading is posted to the upside, I would like to. But also what you need to understand, guys, is that you've got enough room on the playing field as well, because I meet a lot of people who start getting pretty good at finding supply and demand zones, but what they aren't good at is understanding where demand and where supply should be. So finding the zones is first. Knowing when to use demand and when to use supply is another thing, and that's a subject, for another webinar. Not because I'm trying to hold any information from you. There's a lot of information to it. You know what I mean? As I know you can understand and respect, there's a lot of moving parts to it. But in one of our premium webinars we'll do, absolutely, that's good. You could use a weekly chart for 5-minute chart trading. You're probably not going to get, I think the weekly is probably not going to be too much use to you, unfortunately, Gerald, because it's too big compared to a 5-minute chart. And somebody asked me, Sam, does it matter, what time frames you use? It depends on your style of trading. Me personally, I'm all about, understanding. I'm all about the bigger time frames, because what I like to do is I like to set and forget my Forex trades, and let them all develop real nicely, and let them do their thing. So I'm not in a rush. I'm like about getting in, finding the very best moves I can, and taking those. So one key area I've got my eye on at the moment, which I'm really looking at is on the New Zealand Japanese yen. I love a lot of the cross pairs here. And I got a real nice area right here that I've been looking at. And, then again, look what that tells me is a ton of institutional selling, in that area. And, overall, we could say, yeah, this is still in a downward trend. And, in your answer to your question, we've got a nice area right here on this area here. And, well, why is the supply not at 78? Well, we've got to deal with the supply at 76 before we can even get to 78. You understand? The price has got to deal with this before it even gets to this. You understand? There could be supply at 78, but you got to deal with what you got in front of you, right? The guy in front of you, okay? Yeah, taking trains on new imbalances form without taking the opposite zone first is deadly. Again, it can be if you've got a good system to understand where you are in the overall picture of playing field. It's a lot safer. A lot of people don't understand, unfortunately, where they are in the overall location. And that's why, this is definitely something for us to discuss in our next webinar as well. But this for me would be a nice trend trade to get into this area here. I'd expect a turn in price and be looking to start getting on the short side of things from around this 76, 77. I'd want to have my stops a little bit above here. Now, obviously, I don't really see any good quality demand again. on this market until we get back down to here. So does that offer me at least a 3-to-1 risk to reward on there? I'd say it does to that opposing area. And also that would be a good first target, because if this downward trend is going to continue, I'd expect it to make new lows again as well. Okay. So yeah, at the moment, while that I'm still seeing signs of that downward trend in play, if that area fails for me, I'm happy to go a little bit higher as well. Absolutely. So, and there's only so much. Typically, I have this, though. When I'm finding something to trade, if I get it wrong twice, if I get the direction wrong twice, I reassess and move on. I have a nice little rule in my plan on that to say, hey, if I get that direction wrong, I'll just move on and reassess it. Guys, I've actually found that in my own trading, limiting my losses, okay, I've had X amount of losses, limiting it's always made it better for me, because it's easy to overtrade, don't you think? And sometimes I can look at a chart and never ever find anything. What I'd like to do in our premium webinar that I'm going to, and I'm thinking it's going to be later in March, the date will go out. We could spend some time on that, literally just looking at live charts, just looking at supply and demand, and just getting into that, if that would be pretty useful to all of you guys as well, and expand upon this further. So we can do this on any time frame. This is why I don't use the news. This is why I don't use indicators. And like I said, even on a smaller time frames, for quick easy trades that we can get on here, it works intraday, where we've had our trade here, a quick easy 750. You knock a couple of those out every day, guys. These aren't a bad living. It's a wonderful thing. So I like to do my day trading on these small markets, and I like to do my longer term trading on my Forex trading and options as well. So there's a lot of cool things that we do. I mean, me personally, I trade everything. I trade stocks, futures, Forex, options. I do a lot as well. Right, if the 76 is taken, I suppose it makes a pullback in the demands are a probable trade consideration. Absolutely, because then maybe it looks like the trend is shifting. Absolutely. Absolutely. Just trying to get an idea of it. It's all about, having a picture and a sequence on there as well. Okay. So, listen, just before we go, I hope you found that useful. What I want to share with you as well, guys, is just a couple of ways you can stay in touch with me as well. I had a couple of you email me last time with some questions and so on. If you want to get in touch with me directly, the best way to do that is to follow me on Twitter. Okay. I do analysis on a daily basis. I do, Michael, through OTA, but for now, I'll give you some more ideas on all of that. For now, this is the best way to kind of get into my mindset, and what I do is by following me on Twitter, okay? And I'll show you where my articles are. I'll show you where Twitter is, and I'll also link you to where you can find some more information out about what we do at the Academy, okay, guys? So if you like what we see, I've got plenty of stuff I want to share with you right now. So if you like that, I do a lot of links, and you can email me. Feel free to email me as well. Just do it through Twitter. Direct message me through Twitter. My handle is @SamEvansTrader. @SamEvansTrader. I'll also do this. I'll bring it up here. I'll show you on this. If I go over to here, I'll pull up. I've got a little kind of thing on here for you. There you go. This is the best way to catch me. So you can get me at sam.evans@otahq.com. You can follow me on Twitter @SamEvansTrader. On Twitter is a good way to message me. I actually am quite active on Twitter, so that's a really good place to get me. Or if you go to tradingacademy.com, and if you go to tradingacademy.com, here we are. If you are local, if you actually fancy to find out more about what we do here, go to one of our free workshops even. They discuss this even more detail with live markets as well. You can actually go to one of our free classes on there as well. You can actually get your free insider kit on here as well by looking at this, which is our tools on this. If you can click on this, you can actually click on that. You can also, under tools, go to lessons from the pros. And if you click on lessons from the pros, here we go, guys. There's actually an article about setting profit targets, what we were just talking about. My article was actually released yesterday. I actually did release an article yesterday. My recent one is making money in Forex when you are wrong. Okay, making money in Forex when you're wrong. If you click that one on there, and this is the last one is about this. And there's actually some examples about that as well, if you want to add that on as well. So check that out, and there's a whole selection of those as well. All right, guys. So hope you enjoyed that. I'll give you more details soon about the premium webinar, hopefully on that. And guys, thanks for your participation. Have a great trading week. Always a pleasure. Thanks for having me, FX Street, as well. But yeah, feel free to go on there. You can register for one of our free webinars on there. You can get me on Twitter as well. We're all good. All right. Have a great day, everybody. And thanks, FX Street. Take care. Thanks, everybody.